In this video, I'll share other important legislation that is used frequently in the workplace. These 5 acts shown in the boxes are listed from earliest to most recent. They'll be covered in summary format, indicating who they apply to, the provisions, and compliance requirements. The website where the full act can be found is provided. The Consolidated Omnibus Budget Reconciliation Act, COBRA, of 1986 requires employers with 20 or more employees offering health insurance with group health insurance programs to offer terminated employees the opportunity to continue their health program coverage after they're no longer on the payroll or no longer qualify for benefit coverage because of a change in employment status, for example, reduction in hours. The cost must be at group rates, and the employer can add a small administrative charge of up to 2%. Many employers outsource these programs to handle the billing and provide the collection services. The duration of coverage is dependent on some variables, so it may be different from one person to the other. This act was amended in 1989 and 1986. Over a year in the making, on May 26, 2004, the Department of Labor, DOL, finalized the proposed COBRA regulations that contain dramatic changes to the COBRA notices as well as the manner in which notices were to be issued. There is an update to the general and qualifying event notices. The provision to provide initial notices within 90 days. To establish a reasonable notification procedure. To notify individuals whose coverage ended. And to provide a notice of unavailability of continuation. The Health Insurance Portability and Accountability Act, HIPAA, of 1996 was signed by President Bill Clinton on August 21, 1996. The act consists of 5 titles. Title I of HIPAA protects health insurance coverage for workers and their families when they change or lose their jobs. Title II of HIPAA, known as the Administrative Simplification (AS) provisions, requires the establishment of national standards for electronic healthcare transactions and national identifiers for providers, health insurance plans, and employers. Title III of HIPAA sets guidelines for pre-tax medical spending accounts. Title IV of HIPAA sets guidelines for group health plans, and Title V of HIPAA governs company-owned life insurance policies. The act was created primarily to modernize the flow of healthcare information, stipulate how personally identifiable information, PII, maintained by the healthcare and healthcare insurance industries should be protected from fraud and theft, and address limitations on healthcare insurance coverage. Most employers and their employees will be familiar with Title I. This law ensures that individuals who leave or lose their jobs can obtain health coverage even if they or someone in their family has a serious illness or injury or is pregnant. It also provides privacy requirements related to medical records for individuals as young as 12. It limits the exclusions for pre-existing conditions, and it guarantees renewability of health coverage to employers and employees, allowing people to change jobs without the worry of loss of coverage, and it restricts the ability of employers to impose actively at-work requirements as preconditions for health plan eligibility, as well as a number of other benefits. In April 2001, the Department of Health and Human Services, HHS, issued privacy regulations that were required by HIPAA. The HIPAA privacy rule establishes national standards to protect individuals' medical records and other personal information, PHI, and it applies to health plans, healthcare clearinghouses, and those healthcare providers that conduct certain healthcare transactions electronically. The coverage details are shown in the first column on the table displayed. The rules requires appropriate safeguards to protect the privacy of personal health information and sets limits and conditions on the uses and disclosures that may be made of such information without patient authorization. This is addressed in the middle column. The rule also gives patients rights over their health information, including rights to examine and obtain a copy of their health records and to request corrections. The new regulations include stiff civil and criminal sanctions for violations, civil penalties of $100 per violation, and up to $25,000 per person each year can be assessed. There are 3 levels of criminal penalties which are outlined in the column on the left. The final rule on security standards was issued on February 20, 2003 and took effect on April 21, 2003, with a compliance date of April 21, 2005 for most covered entities and April 21, 2006 for small plans. The security rule complements the privacy rule. While the privacy rule pertains to all protected health information PHI, including paper and electronic, the security rules deal specifically with electronic protected health information EPHI. It lays out 3 types of security safeguards required for compliance: administrative, physical, and technical. It provides funding to improve the nation's health care information technology systems, and it includes incentives to promote the use of electronic health records, telemedicine, and clinical data repositories. The Small Business Job Protection Act, SBJPA, of 1996 made it easier for small businesses to operate and create jobs. It raised the minimum wage and made significant changes to pension plans. The definition of highly compensated employees was narrowed, which simplified the calculation of contribution limits for highly paid employees when lower paid workers do not meet the contribution thresholds. The Act also amended the Portal to Pay Act by declaring that hourly employees who commute to and from work voluntarily in company-owned vehicles do not need to be compensated for this time. The Act also replaced the Targeted Jobs Tax Credit Program with the Work Opportunity Tax Credit Program, WOTC, that allowed employers a credit of percentage of wages paid for qualified members. The Act also simplified the rules for determining the status of independent contractors. If an employer satisfies the requirement of a reasonable basis test for classifying independent contractors and cooperates with reasonable information requests from the IRS, the burden of proof switches to the IRS to prove that the individual is not an independent contractor. After 1996, the lending institutions no longer enjoyed the benefit of having to pay tax on only half of their interest income from money lent to employee stock ownership plans, ESOPs. Although the main focus of the Sarbanes-Oxley Act, SOX of 2002, is the reporting of financial transactions and activities, HR professionals may be called on to participate in SOX reporting requirements. The Act requires information that materially affects the organization's financial status to be reported to the Securities and Exchange Commission, the SEC, in some cases immediately, when the organization becomes aware of the information. Here are some instances where this would apply to HR. Ensuring that material liabilities from pending lawsuits or settlements of employment practices claims are reported in the financial statements. Participating in the review and testing of internal controls for hiring, compensation, and termination practices. Reporting immediately any material changes to the organization's financial condition. Although, in most cases, this wouldn't be an HR responsibility, the settlement of a large class action lawsuit could potentially reach the threshold of a material change. Failure to provide this information within the timeframes required by the Act can result in criminal penalties, including incarceration, for employees who obstruct legal investigations into financial reporting issues. The Act also prohibits employers from retaliating against whistleblowers who report financial conduct that they reasonably believe violates federal laws designed to protect shareholders from fraudulent activity. The Genetic Information Non-Discrimination Act, GINA, of 2008 protects individuals on the basis of their genetic information in both employment and healthcare, and adds a new protected class for purposes of equal employment opportunity law. The Act makes it illegal for an employer to discriminate against an employee due to the employee's genetic information or family member's genetic information, and for genetic information about a person or a family member to be used to deny enrollment in an insured or self-insured healthcare plan, or to change the person's premiums or contribution rates. This legislation was brought about by insurance companies using genetic information to determine who would likely have expensive diseases in the future. That information allowed decisions to exclude them from hiring or enrollment in medical insurance programs. With the implementation of this law, those considerations are no longer legal.